You reach into your wallet or pull up your banking app, and you see numbers. You see balances that you assume belong to you, figures you believe you can spend, save, or invest at will. But the truth is unsettling. Those numbers are not fully yours. The money you think you control, the dollars, euros, or rupees in your account, exists only because a larger invisible system allows it to exist. A system whose rules you have never agreed to and whose mechanics you barely understand. Every deposit, every withdrawal, every loan, every swipe of a credit card interacts with forces beyond your perception, forces that govern the flow of wealth on a scale far greater than any individual. And right now, this matters because the global economy is shifting faster than most people can grasp. Inflation is rising in some countries, while other regions are sinking into debt crises. Interest rates fluctuate, and central banks announce policy moves that ripple through international markets. These are not random events. They are the outcome of a tightly controlled system designed to manage risk and incentivize profit for those who operate at the top of the financial hierarchy, not for ordinary account holders like you. Understanding this is not just theoretical, it is critical if you want to comprehend the reality behind your own money, the reality that affects your lifestyle, your savings, and your financial future. At the heart of the system is a mechanism that is both brilliant in its simplicity and chilling in its implications: fractional reserve banking. You deposit $100 in a bank, you believe it is safe, stored in a vault under lock and key, ready for you to use whenever you need it. But the truth is that the bank does not sit on that money. They lend most of it out, often 80 to 90%, to someone else, someone who is borrowing to buy a house, start a business, or cover personal expenses. In doing so, your money exists in two places at once: in your account, where you believe it is fully available, and in a loan elsewhere, generating interest and profit for the bank. The process repeats across multiple institutions, creating a cascading effect in which the original deposit can effectively multiply into many times its original amount in total credit within the economy. This is the hidden engine of money creation. Your balance feels tangible and secure, but in reality, it is a thread in a much larger web of obligations, debts, and credits, a system designed to expand wealth for those who control it. And while banks profit handsomely from the interest on loans, fees, and the leverage that fractional lending provides, the risk of failure is socialized. The financial crises of the past decades, most prominently the crash of 2008, revealed the asymmetry of this system. Millions of individuals lost homes, retirement savings, and jobs, while the institutions responsible for the collapse were rescued through government intervention funded by public resources. The money you thought was yours contributed to this cycle, not as a participant with agency, but as fuel for a machine whose logic was entirely independent of your own financial well-being. Beyond the mechanics of fractional reserve lending lies the role of central banks and the creation of currency itself. Modern money is overwhelmingly digital. It is not backed by gold or silver, but by the collective trust in governments, central banks, and the financial institutions that manage the flow of credit. When a central bank decides to inject liquidity into the system, adjust interest rates, or engage in quantitative easing, it is not thinking about your individual savings account. It is managing a complex web of national and international obligations, aiming for macroeconomic stability. Yet the result is deeply personal. Your purchasing power shifts, often subtly at first, but significantly over time. Inflation erodes the real value of your earnings. Currency fluctuations can suddenly alter the cost of imports or the value of investments. And all of this occurs without your direct involvement, guided by a system whose incentives are misaligned with your own. Public narratives exacerbate this disconnect. Headlines proclaim booming markets, record highs, and unprecedented growth, while the everyday experience of most citizens remains largely unchanged. Wages stagnate. Savings earn negligible interest. The stock market rewards early adopters and those with scale and access, while average account holders see little benefit from the apparent prosperity. This gap between perception and reality is deliberate, or at least inevitable, given the structure of the system. The numbers that appear in glossy reports often hide the uneven distribution of wealth, the concentration of credit, and the asymmetric risks that ordinary participants absorb. Debt is another layer of the same architecture. Governments borrow to fund public projects, banks lend to individuals and corporations, and credit systems extend far beyond what the average consumer might imagine. Debt is not merely a tool for convenience. It is a mechanism of control, a way to channel resources through structures that prioritize repayment to lenders and investors above broader societal well-being. When debt grows too large or repayment fails, crises emerge. Yet the system is resilient precisely because it can. Externalize these risks. Losses are borne by society at large, while the creators and managers of credit continue to operate, often with minimal consequence. Consider the mechanics of a single credit card. You swipe a purchase of $100. Instantly, that money is transferred, not from a vault where cash is stored, but from a complex chain of settlements, banking reserves, and interbank loans. The bank earns a percentage in fees, while payment processors take a cut. Your purchase is real, but the money itself is fleeting, existing in a fluid state of accounting entries and digital promises. Multiply this process across billions of transactions daily, and the scale becomes almost incomprehensible. The irony is stark. The more people trust the system blindly, the more their understanding of it diminishes, and the more their control over their own money erodes. The invisible architecture of global finance rewards those with early access, scale, and leverage, while providing only the illusion of security for the majority. Yet the stakes are far higher than personal inconvenience. These same forces shape economies, influence governments, and determine the stability of entire nations. Policies enacted in central bank boardrooms ripple outward, affecting employment, purchasing power, and financial freedom in ways most citizens never see or understand. Consider global interconnections. A banking crisis in one country can trigger cascading effects across continents. Exchange rates fluctuate, interest rates rise or fall, and investment flows shift rapidly, all while ordinary individuals attempt to navigate their lives, pay bills, and save for the future. The power to create money, to manage credit, and to influence economic outcomes resides in very few hands. And those hands operate according to rules and incentives that are largely opaque. Even seemingly simple economic events, like a change in interest rates, carry profound consequences. Borrowers may struggle to repay loans, investors may gain or lose fortunes overnight, governments may adjust fiscal policies, impacting social programs and infrastructure spending. And yet, the individual consumer experiences only a fraction of this complexity, rarely aware of how intertwined their finances are with global mechanisms. Over decades, this system has created cycles of boom and bust. Wealth accumulates at the top, while risk is distributed more broadly. Crises are inevitable, yet the system is designed to absorb them and continue. Individuals may lose homes, savings, or jobs, but the financial architecture persists. It is self-sustaining, self-reinforcing, and often indifferent to the personal costs. All of this is made possible by trust. Trust in banks, trust in central banks, trust in governments, and trust in the currency itself. Without it, the entire machine could collapse. But trust is not the same as control. You may rely on the system, but you do not command it. Your money exists within constraints and mechanisms you cannot fully see, let alone manipulate. In the end, the uncomfortable truth is that the dollars in your account, the balances you track, and the wealth you believe you hold are all part of a larger architecture of power and incentives. They are simultaneously yours, someone else's, and part of a chain of obligations that spans the globe. The numbers feel tangible because we need them to feel tangible. But beneath the surface lies a fluid, dynamic, and often unforgiving system that is not designed for individual empowerment, but for stability, leverage, and profit at scale. Every decision by a bank, a central bank, or a government carries consequences that ripple through your life, often unnoticed. The more you rely on the apparent security of your money, the more you are participating in a game whose rules were not written with you in mind. And when the inevitable shifts, crises, or policy changes occur, you will feel the impact, because control is not evenly distributed. It belongs to the institutions that manage creation, distribution, and circulation of wealth, leaving ordinary account holders to navigate the consequences with limited visibility and agency. Perhaps the most unsettling part is how invisible all this is. Daily life, spending, saving, earning, everything feels normal. You do not see the chain of fractional lending, interbank settlements, central bank maneuvers, and policy decisions that underpin every transaction. Yet they exist, and they matter. They shape not only the economy, but your personal financial reality, subtly and relentlessly. Your money is real enough to pay for groceries, to buy gas, to rent a home. But it is simultaneously an instrument in a system that has its own logic, priorities, and incentives, one that does not pause for your convenience or your understanding. You may earn it, spend it, and even invest it, but the underlying forces that govern its existence operate largely beyond your perception. The cold reality is that the financial system is designed to perpetuate itself, reward the few with scale and leverage, and socialize the risks for the many. And the paradox is simple, yet profound. The more we trust it, the less we control it. Every dollar, every euro, every yen in your account is both a tool and a tether, a representation of wealth and a reminder of how much you do not own. So when you check your balance again, when you glance at the numbers that you assume are yours, remember this. They exist because of invisible rules, because of incentives that favor institutions over individuals, because of mechanisms designed to expand, leverage, and absorb risk at scale. And in a world where money is partially yours and partially a promise within a vast financial network, one question remains unavoidable. If your money is not fully yours, who truly decides its fate? And how much of your life depends on rules you can never see or change?